Right now, millions of investors are making the worst trade in stock market history. They're not using leverage. They're not buying meme stocks. They're doing exactly what every financial advisor told them to do. Nassim Taleb tells the story of a turkey. The turkey is fed every day, 1,000 days of evidence that the farmer is a friend. Each feeding confirms what the turkey believes. Life is good, tomorrow will look like today. Day 1000 is the turkey's most confident day. Day 1001 is Thanksgiving. This isn't just a metaphor. It's the pattern behind every major market crash. Confidence peaks right before catastrophe, not despite the coming disaster, but because of the conditions creating it. As you're watching this, investor confidence sits near record highs. Portfolios are concentrated in ways we haven't seen since 2000, and everyone feels safe. The question isn't whether you're the turkey. The question is, what day is it? Chapter 1. Historical rhymes. History doesn't repeat, but it rhymes in ways that cost people fortunes. 1929, 2000, 2008. Each crash felt unique to people living through it, each preceded by experts explaining why the old rules no longer applied. Before 1929, they said the Federal Reserve had eliminated the business cycle. Before 2000, eyeballs mattered more than profits. Before 2008, housing prices never fall nationally. Every bubble follows 5 stages. First, this time is different. Second, the fundamentals justify it. Third, you just don't understand. Fourth, okay, that was bad. Fifth, nobody could have seen this coming. Except people did see it coming. Every single time. They were just ignored, mocked, or early, which in markets amounts to the same thing. We're not predicting a crash. Prediction is a fool's game. We're recognizing a pattern. Concentration at historic levels. Valuation stretched. Confidence high. We've seen this pattern 4 times in a century. We're looking at conditions that rhyme. Chapter 2. When smart money becomes dumb money. In 1998, long-term capital management employed 2 Nobel Prize winners. They built models more sophisticated than anything Wall Street had seen. They had $4 billion. They lost it in weeks. Nobel Prizes don't protect against the one scenario your models didn't anticipate. In 2021, Archegos Capital lost $20 billion in 48 hours. Leverage so extreme that when positions moved against him, banks couldn't sell fast enough. These weren't amateurs. These were the smartest people in the room, with the best tools, the best data, and they blew up. The pattern is consistent. Sophistication plus leverage plus overconfidence equals catastrophe. Not sometimes. Repeatedly. If Nobel laureates can lose everything, what makes any of us think we're immune? Even the smartest turkeys get Thanksgivinged. Credentials don't change the calendar. Chapter 3. The hidden tax on your brain. There's a number that should haunt every investor. 4%. Dalbar has tracked investor behavior for 30 years. The average investor underperforms the market by 4 to 5% every single year. Not because of fees, not because of bad advice, because of behavior. Buying near the top, selling near the bottom, doing exactly what emotions demand and exactly what wealth requires you not to do. We'll spend 3 hours reading reviews before buying a $50 appliance, then make investment decisions based on how we feel after checking the news. 4% doesn't sound catastrophic, but compounded over 40 years. That's the difference between retiring at 62 and retiring at 70. The biggest threat to your portfolio isn't the market. It's the tax your brain charges you for the privilege of feeling like you're doing something. Chapter 4. The concentration you don't see. If you own an S&P 500 index fund, you probably think you own 500 companies. You don't. You own 7 companies, with 493 along for the ride. Apple, Microsoft, Amazon, Google, Nvidia, Meta, Tesla, the Magnificent Seven now represent over 30% of the index. That's not diversification. That's 7 companies wearing a trench coat pretending to be an index. It gets worse. These 7 are all in the same sector, exposed to the same risks: interest rate sensitivity, AI spending cycles, antitrust pressure. When one falls, they tend to fall together. When someone says they're diversified across index funds, what they often mean is they own Apple in their US fund, Apple in their tech fund, and Apple in their total market fund. That's buying the same outfit in 3 colors. 1,000 days of evidence says index funds are safe. Contributions flow in automatically, prices rise, concentration increases, and everyone feels protected. The turkey felt protected too, right up until the pattern broke. Chapter 5. When diversification fails. Diversification is supposed to protect you. Own different assets. When one falls, others rise. Simple math, simple safety. Except during a crisis, when you need protection most, correlations go to 1. That means everything you own goes down at the same time. Stocks fall, bonds fall, international falls. Your diversified portfolio becomes diversified sadness. In 2022, the 60/40 portfolio had its worst year in decades. Both sides fell together. The thing designed to save you decided to sink alongside you. This happens because correlations are measured during normal times. When everything's calm, assets move independently. But stress changes behavior. Panic selling doesn't discriminate. When everyone needs to exit at once, every door leads to the same room. True diversification requires assets that stay uncorrelated during stress. Much harder to find than a pie chart suggests. The turkey was diversified across feeders, multiple food sources, different times of day. Same farmer, though, same Thanksgiving. Appreciate you sticking around. If you liked what you heard, smash that like button, hit subscribe, and drop a comment. I'd love to hear your take. And if you know someone who'd enjoy this, share it with them. Chapter 6. The trade happening right now. So here's where we are. Concentration in 7 stocks at levels not seen since the dot-com peak. Passive flows automatically buying whatever's already gone up. Correlations that will spike the moment stress arrives. And millions of investors who believe they're diversified because nobody told them to check the math. The worst trade in stock market history isn't one person making a bad bet. It's millions making the same safe bet at the same time, creating the very risk they think they're avoiding. If you wanted to design a system to build a bubble, you'd create automatic contributions buying the same stocks, weighted toward whatever's already risen, with no mechanism to ever sell. We built that. We called it passive investing. Michael Burry called index funds the next big short. That was years ago. Concentration has only increased. We're not predicting when this breaks. Timing is impossible. But the conditions are clear. Day 1000. Record confidence. Everyone fed. What day is tomorrow? Chapter 7. Building anti-fragility. There's a concept that changes how you think about risk. Nassim Taleb calls it anti-fragility. Fragile things break under stress. Robust things survive stress. Anti-fragile things get stronger from stress. Most portfolios are fragile, designed for calm. When volatility spikes, they suffer. The goal isn't just to survive turbulence, it's to build positions that improve when things break. In March 2020, Universa Investments returned over 4,000%, not despite the chaos. Because of it, they'd built a portfolio designed to profit from exactly the kind of disruption that destroys traditional allocations. This isn't about predicting crashes. Prediction is unreliable. It's about structuring positions so you don't need to predict. Limited downside when you're wrong. Significant upside when chaos arrives. The turkey couldn't become anti-fragile. Its fate was fixed. But your portfolio isn't a turkey. You can design it to benefit from volatility. Stop trying to predict the next crash. Start building a portfolio that doesn't need you to. Chapter 8. The Barbell Strategy. Taleb offers a specific framework, the barbell. Put 85 to 90% in extremely safe assets, treasury bills, cash equivalents, then 10 to 15% in highly asymmetric bets. Limited downside, unlimited upside, nothing in the middle. The middle is where portfolios quietly bleed. Medium risk assets create the illusion of safety while exposing you to tail risks. Modest returns when calm, serious losses when not. The barbell sounds extreme. 90% treasuries, 10% speculation. But consider the alternative. Balanced funds secretly correlated to the same factors. That's diversifying across different rooms on the Titanic. With the barbell, you know exactly what can go wrong. Safe assets stay safe. Speculative assets might go to zero. But you sized them to survive that. And when chaos creates opportunity, you have capital ready. Explicit extremes beat hidden fragility. Every time. Chapter 9. Ultimate Edge. After everything we've covered, here's the honest answer about what the market will do next. I don't know, and neither does anyone else. The 4 most expensive words in investing are, "This time is different." The 4 cheapest, "I do not know." One costs fortunes, the other builds them. Everyone wants the edge, the insider insight, the guru prediction. But the real edge is simpler and harder. Build a portfolio that doesn't require you to be right about the future. Because you won't be. The investors who thrive across decades aren't the ones who called the top or timed the bottom. They're the ones who structured positions to not need perfect timing. Anti-fragile by design, humble by necessity. The turkey thought it knew what tomorrow would bring. 1,000 days of evidence, total confidence. You now know something better. You know that you don't know. And you've built for it. That's not uncertainty. That's the edge.